Your crypto gains just got wiped and the Fed hasn't even spoken yet. Oil hit $100 while gold failed to hold $4,000. Markets closed Friday, July 24, 2026. Here is where everything ended the week. Like and subscribe for daily market updates. Today's agenda: market snapshot, the oil shock, crypto under fire, gold struggle, Fed rate watch, week in review. Up next, the oil shock. For the record, WTI crude is lower on the day, down about 3%. For the record, WTI crude is lower on the day, down about 3%. Let's look at the numbers before we dissect them, because they tell a story of fear and profit-taking all over again. Bitcoin sits right now near $63,900, down about 2% from its recent highs. Ethereum is hovering around $1,857. After breaking below that $1,900 resistance level you were watching closely. The Nasdaq dropped 6.4%, while the S&P 500 barely moved up 0.5% to close near 7,412 points. Gold actually gained 0.5%, but is still struggling back toward $4,000 instead of staying above it. Oil crashed 3.12% today, ending at 89.31 cents per barrel after briefly touching the century mark. The dollar index stayed flat around 101.47, while 10-year yields dipped slightly to 4.68%. So how is this oil spike hurting the crypto market specifically? Oil breached the critical $100 per barrel threshold earlier this week, triggering an immediate repricing of expectations across global energy stocks and airline balance sheets. This structural shock stemmed from Houthi forces launching coordinated attacks on 2 Saudi tankers in the Red Sea. These strikes effectively opened a second strategic choke point beyond the volatile Strait of Hormuz, severing approximately 20% of global seaborne oil supply. Consequently, shipping routes diverted thousands of miles around Africa, inflating logistics costs overnight. The trigger was Iran's outright rejection of recent ceasefire offers, signaling that regional conflict is transitioning from skirmishes into a sustained proxy war, with direct implications for Western energy security. This global political escalation sent shockwaves through global supply chains, causing Brent crude futures to surge past psychological barriers held firm since the post-pandemic recovery era. Historically, oil prices above $100 coincide with stagflationary pressures in major economies like the United States and Europe, eroding consumer purchasing power, while forcing central banks into a dilemma between curbing inflation or risking recession. For investors, this environment demands rapid reassessment of exposure. Airlines face margin compression that could persist for quarters as fuel hedging strategies become obsolete overnight, while renewable energy projects suddenly look less competitive against artificially high fossil fuel prices. The second-order effects are equally dangerous. Higher input costs will inevitably filter down to retail pricing, potentially reigniting inflation expectations, just as policymakers hope to gain traction with rate cuts. Consequently, the market no longer views this spike as a temporary blip, but rather the beginning of a prolonged period, where energy unpredictable price swings becomes the primary driver of global big-picture economic stability or instability. But wait, gold didn't crash like Bitcoin did. Here is why that matters so much for your portfolio balance sheet today. Bitcoin dipped below $65,000 as risk-averse investor mood swept across Wall Street and global markets, ending weeks of remarkable resilience despite escalating conflicts. That durability relied on an assumption ample, available cash in the market would support high-beta assets during global political turbulence. However, the foundation crumbled instantly when Brent crude oil surged past $100 per barrel, signaling a sharp rate change toward stagflation fears rather than pure inflation or growth concerns. The mechanism is clear. Soaring energy costs compress corporate margins and consumer spending power, forcing central banks to reconsider in favor of lower rate stances, while raising interest rates financial conditions globally. This creates an immediate available cash in the market crunch that investors instinctively flee from the most volatile market corners first. Digital currencies, viewed as high-risk growth plays in normal times, became primary targets for capital rotation into perceived safety havens like U.S. Treasuries or gold, when energy prices threatened to anchor inflation expectations higher than anticipated. Historically, similar flight patterns occurred during previous oil shocks in 1973 and 2008, where high-beta asset classes suffered disproportionate losses, as markets reprice the cost of doing business upward across every sector. For concrete investors today, this move implies holding volatile crypto positions requires a much higher tolerance for sudden macro-driven drawdowns. It suggests diversification strategies must now account for energy price unpredictable price swings as a primary risk factor rather than just global political headlines alone. The immediate implication is to reduce exposure to speculative digital assets until oil stabilizes and the Federal Reserve's policy path becomes clearer in this new high-cost environment, ensuring portfolios do not suffer from second-order effects of rising production costs that could linger long after prices settle. That brings us to Federal Reserve Rate Watch. The twist nobody saw coming was gold's surge above $4,100 this week, only to surrender those gains once revived inflation fears from rising oil prices forced the reversal. This sharp move stems from the zero-sum relationship between energy costs and real yields. As crude climbs, production expenses rise across every sector, pushing consumer price indexes higher. Investors consequently demand a premium on nominal assets like treasuries rather than non-yielding metals, forcing a painful reevaluation of safety in an uncertain world. Historically, gold served as a reliable hedge against currency debasement during stagflationary periods driven by oil shocks, such as the 1970s energy crises, where precious metals rallied for decades, before stabilizing only after supply chains normalized and inflation expectations anchored. However, today's structural shift differs significantly. Unlike past temporary spikes caused by global political friction or OPEC quotas, current elevated energy costs appear embedded in global logistics due to a fractured supply chain and the transition away from cheap fossil fuels toward more expensive green alternatives. This creates a second-order effect, where high oil prices permanently elevate the baseline cost of doing business, effectively raising the inflation floor for years rather than months. Consequently, investors realize that even traditional safe havens can be vulnerable if energy costs remain structurally higher. The implication is clear. Capital allocation strategies must now account for an environment where inflation persists without a corresponding drop in oil prices. Gold may struggle to act as a standalone shield unless central banks aggressively cut rates or supply constraints ease unexpectedly. Let's review the past week to see where we went wrong and right on our calls before things got this messy again. Market perception shifted dramatically Wednesday as September rate hike probabilities surged to 80%. Driven by surging crude oil prices and unexpectedly sticky inflation data. This spike represents a fundamental recalibration of the Federal Reserve's policy trajectory. Persistent price pressures are forcing markets to anticipate an aggressive raising interest rates stance beyond current expectations. When borrowing costs climb, how expensive assets look relative to earnings change instantly, because future cash flows face higher discount rates. This mechanism explains why high beta names like Tesla and Alphabet suffered sharp declines earlier this week. Their prices rely on optimistic long-term earnings that become fragile when interest rate uncertainty dominates investor mood. Historically, similar unpredictable price swings occurred during the 2013 taper tantrum, where premature policy normalization hints triggered a technology sector sell-off before rates rose enough to impact underlying health permanently. For investors holding these positions, capital preservation now demands pivoting toward defensive assets or firms with strong balance sheets capable of servicing higher debt without eroding margins. The second-order effect involves reduced available cash in the market in corporate bond markets and potential credit raising interest rates for smaller firms dependent on cheap financing. Consequently, portfolio construction must evolve from chasing growth at all costs to prioritizing companies generating immediate cash flow regardless of the rate environment. Ignoring this shift risks significant downside exposure as the Fed's in favor of higher rates rate change accelerates, squeezing profit margins across industries reliant on consumer spending and capital expenditure before inflation fully cools in late 2024 or early 2025. Finally, let's wrap up with what you need to watch tomorrow morning before the bell rings again next week. Our forecast regarding crude oil gapping upward upon futures reopening held true last night, driven by escalating global political friction threatening to sever critical supply lines, before Iranian authorities can establish alternative channels for settling transactions in US dollars without triggering severe sanctions penalties. The immediate market reaction saw the dollar appreciate exactly 0.3% as traders scrambled to hedge against potential energy price unpredictable price swings and inflationary spikes. This move mirrors historical patterns seen during the 2019 Strait of Hormuz tensions, where even brief threats caused oil prices to surge, while a safe place to store wealth currencies strengthened temporarily, before stabilizing once diplomatic pathways emerged or supply fears were already expected. By the market, the mechanism is straightforward. Any ambiguity regarding Iran's ability to sell dollars directly impacts global available cash in the market and energy pricing models underpinning the entire financial system. If Iranian exporters cannot access dollar reserves, they must rate change to non-dollar settlements like yuan or crypto, which could fragment existing trade networks, but ultimately force a revaluation of commodity-denominated assets globally. For investors holding long positions in stocks tied to energy production, this unpredictable price swings creates immediate risk management challenges. Hedging strategies using puts become essential as second-order effects ripple through supply chains dependent on stable fuel costs. Conversely, those positioned in hard currency or defensive sectors may find short-term gains from the dollar's strength, though prolonged instability could erode these advantages if global trade slows significantly due to payment system fragmentation. The key takeaway remains that global political risk premiums are now permanently embedded in energy, how expensive assets look relative to earnings, requiring a more cautious approach to portfolio allocation until clearer diplomatic resolutions emerge. Markets closed Friday with oil reaching $89.3 per barrel as escalating Red Sea attacks renewed global concerns over supply disruptions, driving energy prices toward the century mark. Meanwhile, Bitcoin retreated below the $65,000 threshold to settle near $3,900 following a turbulent week fueled by Middle Eastern tensions. Gold also faced pressure and struggled to maintain levels above $4,100. Despite these challenges in commodities and tech stocks due to rising borrowing costs, investors remain closely watching geopolitical developments that continue to shape market volatility across energy and digital asset sectors. Thanks for watching Market Pulse Daily.